Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Well, welcome to the show. My name is Roger Whitney. I am your host. I'm excited you're here. It is February, and we just completed our latest Retirement Plan Live case study with the results webinar last Thursday. It feels like a whirlwind because literally the next morning, crazy early, I flew out. So I didn't really have much time to reflect on it yet. If you saw the webinar, I hope you enjoyed it and the case study. Joelle was an awesome candidate, I think. If you missed it and want to see the results show where we go through the analysis, you can go to rogerwhitney.com and under free resources, we have the replay. And if you can't find it, just shoot us an email at roger@rockretirementclub.com or rogerwhitney.com. They actually both go to the same place, and we'll be happy to send you a link. I want to thank everybody, by the way, for their well wishes regarding my back and my neck. If you watch the replay, I'm very uncomfortable. I think I pinched a nerve in my upper neck, and it's been bothering me for about 2 weeks now. And if I move a certain way, I get a huge zing down my right arm. I'm actually going to the doctor today, just the general practitioner, to get some counsel on it. It's been getting a little bit better. I've had a chance to rest a little bit, so I think that helped a lot. But I appreciate your well wishes. Just want to make sure I say that. Now, if you're not aware, we opened up enrollment to the Rock Retirement Club, our club that has a community where we have meetups every week virtually. We have annual conferences in person. We have a retirement masterclass where you can build your plan of record. You can learn about that at rockretirementclub.com. And we just switched how we're doing this. So the clubhouse is only open until February 6th. That's this coming Sunday, because we're going to bring people in as a cohort so we can have special events and help everybody that comes in get up to speed so they can work towards creating their plan of record and getting integrated into all the things the club has to offer. So you can learn more about that at rockretirementclub.com. All right, so this month, we are going to talk about inflation and retirement. Pretty big topic, isn't it? Pretty topical topic. Inflation is sort of in vogue right now, especially in the media, because we're seeing a lot of data saying that inflation is on the rise and it's higher than it's been in a very long time. And that is concerning, especially if it's a trend. So what I thought we would do this entire month is just walk through inflation as a risk in retirement and spend a whole month in our deeper dives building a case and looking at it with fresh eyes. So today what we're going to do is we're going to just talk about what exactly is inflation and how do we measure it. And then we're going to have Andy Panko on, who's going to answer some of your questions with us. Next week, we're going to talk specifically about how it will impact your retirement. How does inflation impact your retirement in terms of the income that you're going to receive and the spending? In week 3 of this month, we're going to talk about how do we manage inflation from a strategic level? What should we be doing in building our pie cakes and our strategy to deal with this risk? And then in the last week, we're going to talk about what investment vehicles are available to help protect us from inflation. So that's how we're going to think through this in an organized way. And I'll tell you, when we pick these themes, the way we pick these themes are really one of two ways. One is it's something that we hear a lot of questions about, of something that you are concerned about or have an interest in. And the second way is I use this, and this is originally how the show started. I use these themes as a way of refreshing my thinking on a particular subject, because I am a practicing retirement planner. I work with clients and I never want to be stale. I try not to be stale in how I think about things. I like to try to look at them with fresh eyes so I can understand the landscape, question my previous assumptions. So it really helps me sharpen my saw. And so that's how we choose these. And I think this one hits both of those. And so that's the lineup for this week. So let's talk about what exactly is inflation. And I think that's pretty self-evident, right? Officially, inflation is the decline of purchasing power of a given currency over time, right? You got a dollar. That's our currency. The dollar is our currency if you're here in the US. And over time, that dollar buys less of a particular good. So for example, if we look at a gallon of milk, I went to Google and Google tells me that today a gallon of milk costs around $3.59. All right, so if I give my $3.59, I get a gallon of milk. Well, back in 1995, according to Mr. Google, a gallon of milk cost $2.50. So my $2.50 would have gotten me a gallon back in 1995, but today it is $3.59. That is what inflation is. The same good or similar good costs more over time because of inflation. Eggs, we'll use as another example. In 2021-22, a dozen eggs cost about $2.80 for a dozen. Back in 1990, it was about $1. So that increased significantly over that period of time. That is essentially what inflation is. And I think you know this, right? I think back to my first real new car cost, what was it? My first new car was 1990. It was the fall of 1990, and it was a Saturn. And my father-in-law, who works for GM, or did work for GM, had some discounts, but I think I paid about $12,500 for that new car. That same car today would cost a lot more. And you probably remember like our first house, which was worth $90,000. It's probably worth, Lord knows what it is in this housing market. But the cost of goods increase over time, or to say that in the reverse, the purchasing power of your dollar buys less over time. That is essentially what inflation is. And so if we look at history, let's look at history since 1926 through 2020. The average inflation rate was 2.88% a year, meaning that on average, and averages can be dangerous, on average, whatever cost $1 today would cost $1.02. Let's round it up to $1.03 next year. And then the year after that, on average, it would increase by another 2.88%. So that's been the average inflation rate since 1926. I wonder if the dollar store thought of that when they named their stores. I think one of those actually is changing their names. They can't be that dollar store. I'm not saying that's the one. I forget which one it was because things cost more. So if you had the dollar store and they truly only sold something for $1, what would end up happening is over time, the things they would sell would be less and less and less. So you can imagine, say, a dozen eggs, which was $1 back in 1990. 5 years out, you'd only get 10 eggs. And then 5 years out, you'd only get 8 eggs or whatever the math worked out to. That's essentially how inflation works. Now, the highest 1 year inflation over this period of time was 15.61%. And that was in the 80s, I believe. So we've had inflation where something that cost $1 in 1 year would cost $1.15 the next year. So that's the highest reported year over year inflation rate. You can have these 1 or 2 year big spikes. Now, the other thing with inflation, and I think this is really important to understand, is that just like with market averages, you never actually get the average in any consistent way. It can be a very misleading number. Inflation can have seasons over decades or over some period of time. It generally isn't just 1 year and then it goes back. And so from a retirement standpoint, we'll get into this next week, depending on where you retire or the date that you retire and what season you're entering into in terms of inflation can make a big difference. And this is similar to the sequence of return risks that we have for stocks, right? What kind of stock returns do I get after I retire? So as an example, although the average from 1926 to 2020 was about 2.88%, the last 20 years, inflation has been 2.06%. So lower than the average. We've been at a nice tailwind. It's been helping us. Over the last 10 years, the average inflation rate was 1.73%. So over the last 10 years, if you retired in 2011, inflation hasn't really been an issue for you because it's been really low. Over the last 20 years, it's been pretty moderate. But what would happen if you had retired in 1970? Well, if you happen to have retired in 1970, the average inflation rate in the 70s was just over 7% a year. So if you think of 1970, I mean, I was a toddler back then, a wee lad. If you retired in 1970, you had inflation, the cost of the price of things you need to eat and sleep and turn your lights on, etc., was increasing on average by about 7% a year. And that coupled with, so that's a bad sequence of return for inflation, right? And then it was coupled with a pretty rough decade for equities or stocks or investment returns. So that was more of a perfect storm of sorts, whereas over the last 10 years, if you retired in 2011, you got the best of both worlds. You had very low inflation and very strong equity returns. So some of this is just the luck of the dice. And this will become important when we talk about how inflation could impact your retirement. We go through in the 1980s, in which we really think of inflation typically. The average rate was about 5.5%. In the 1990s, it was about 3%. And since 1967, it was about inflation has averaged about 3.92%. So I was born in 1967, just had a birthday. I turned 55. Awesome. So over the last 55 years, I can do that math easy. The average inflation rate was 3.92%. But that wouldn't have been helpful for you because if you retired 10 years ago, you got a lot better than that. So that's essentially what inflation is. And we can see that why this is important because if you are 55, 60, what you care about from a retirement planning viewpoint, obviously, what you care about is what is my inflation rate going to be? What season are you going to enter? So because this is what the impact to the cost of goods that you want to spend money on, your electricity, your eggs, your milk, your salad, your cars, your trips, etc. This is a big issue or a big risk, just like equity returns are a big risk in that sequence. The sequence of this inflation stuff is really important too. Let's say you want to spend $9,000 a month. Let's say that's your spending budget. Just sort of drive this home. And you are 60 years old and I want to spend $9,000 a month to pay for the life of me. Well, if you have 3% average inflation, that $9,000 at age 60 is only going to buy just under $5,000 worth of goods when you're 80 because of the inflation rate. So you don't just need $9,000 each month. You need to make sure that you can increase that amount so you can just continue to buy your full dozen of eggs. So you don't have to buy less eggs because your value of your dollar is going to be cut almost in half. But if inflation is at 6% a year for the next 20 years, that $9,000 in 20 years is only going to be able to purchase about $2,800 worth of goods in today's dollars. So you can see the impact on your lifestyle. And that's why we care about this stuff. So let's briefly talk about what causes inflation. And we're not going to get all geeky here. We just want to have a good grounding so we can think through this together over the month. What can cause inflation? First off, it is a very multi-factor issue here. There's not just one thing. This is much more complex, especially on the global economy than we can really appreciate, I think. But obviously having more dollars in the system, meaning the printing of money, you flush more dollars out there, they're vying for goods. So more dollars in the system could cause inflation because there's much more supply of money chasing particular goods, which can drive up the price. And we've definitely seen a lot of money printing, especially since the 70s, came off the gold standard. And we print money without gold backing it, which is essentially what that is. So we have more dollars out there that can cause inflation. It's interesting. We focus on the supply of money as it relates to inflation. One thing that we don't talk a lot about, or you don't see it at least in the mainstream press, is something called velocity. So having a lot of money out there isn't necessarily going to cause inflation if that money isn't doing anything. So velocity is essentially how quickly that money is being moved around the global economy. So as an example, if the banks are holding a lot of deposits, so they have a lot of cash in the balance sheet of the bank, but that they're not lending and using that money for anything, then it's not necessarily that inflationary because the money is just sitting there literally in a mattress doing nothing. And when we were coming out of the 2008 collapse, that was an issue. The velocity, the level of activity of lending and building and borrowing and all this other stuff slowed to almost a halt. And so some of the reaction to that was to do TARP and TARP 2 and TARP 3. I don't know how many we did, but to get flush money into the economy to try to create inflation because things were slowing down so quickly. So it's not just the number of dollars, but it's the velocity of how much of this money is moving around the system and being used. What else can cause inflation? Well, you have more demand, right? This is basic supply demand. If there's more demand for, I'm trying to think of a common thing that we're all buying right now. If there's more demand for an Xbox, the new Xbox, I'll use this as an example because it's with my son. He wants to buy the brand new Xbox, but there aren't that many out there. In fact, you can't get them from Microsoft directly, but you can find them online. And there are these crazy astronomical prices because the supply is so constrained. There's so few that people can charge a lot more. So demand is an issue, but then the supply part is an issue too. And this is a good example with the Xbox. There is a huge demand for these new fancy machines, and there's no supply, which means people that have them can sell them for a lot higher price than what you could get if all that was normalized. And we're sort of seeing a lot of this right now. And that's the question around inflation is it quote unquote transitory? Meaning, is this just sort of a short-term blip? Initially, the Fed was saying that because there was this argument that, hey, yes, we're seeing year over year inflation increase significantly, but we remember what happened in 2000. Do you remember? We had COVID. Everybody stopped doing everything. They stopped traveling. They stopped going to work. And you saw a big decrease in demand for things. And you also saw a big disruption to supply because plants were running at low capacity because of COVID. They didn't want to have the workers in the plants and they couldn't ship things in because there were all these controls on border and trade. So we had two things happen. We had demand go down, but we also had a big disruption to the supply chain where goods were not being shipped. And now that sort of coming out of COVID, are we coming out of COVID? I hope so. And now as we've moderated from that extreme event initially from the pandemic point of view, and now people are traveling. I was on a plane just this morning coming back from Florida, and the plane was full. The airport was full. The hotel was full. So you have the demand rising, but the supply chain is still constrained. We've all seen the articles or the videos of the boats off the shore of California with all the cargo that they can't get in. There's not enough workers to handle it. I don't know what the deal is. But anyway, so we had the demand increasing, but the supply chain issues haven't adjusted or gotten back to normal. So we have this mismatch, which has caused inflation. So that's one reason why we've talked about this being transitory, potentially. Now, the Fed has taken away that language, but I don't think anybody really knows yet. But that's roughly what causes inflation. Now, last topic for today is how do we measure inflation? We know what inflation is roughly. How do we measure it? Now, there are lots of different measures. Let's just focus on the one that's the most common, which is something that the government keeps. Bureau of Labor Statistics keeps this, and it's called the Consumer Price Index, the CPI. That is the general accepted measure of inflation from a media standpoint. That's the most widely used. So the way they create the CPI is the Bureau of Labor Statistics does surveys of goods and services and housing by visiting and calling stores and checking on what the price of eggs is, as an example. And so the CPI is constructed each month using about 80,000 different consumer goods. They call that a basket of what 80,000 goods is a good representation of stuff that is sold in the economy, goods and services. that we buy in our everyday lives. I don't know if I buy 80,000 different goods, but I mean, I bet if you added it up, it was a lot. From gasoline to apples, cable TV, TV fees, doctor visits, etc. And the CPI measures that same basket and what the price of that basket of goods is year over year. So as they do their surveys, they say, let's survey the cost of eggs just to keep it to one in the basket. Okay, next month, let's survey the cost of eggs at our Kroger or Albertsons. Let's survey the net cost of eggs. And they just do that over and over, except they do it for all of these different goods. And then that is how you get your inflation rate that they publish. Now, not so long ago, the Bureau of Labor Statistics altered how they calculate inflation. The argument went that, well, the consumer price index measure looks at the exact same basket. So that's probably not nuanced enough because people don't continually buy the same things, especially if prices are increasing. Based on cost, it doesn't account for substitutions, was the argument, or is the argument. Meaning that over time, if the cost of filet is increasing, a consumer is going to stop buying as much filet and they're going to buy some T-bones or some strip steaks. They're going to substitute to try to manage their expenses. So you can't just always have filet in the basket. You have to have some mathematical model to say, no, they're not going to buy the filet if it's increasing. They may switch down. They may substitute down to manage their expenses. And so I believe it's since 2017, they said, we're going to measure it in a little bit different way. And I think it's called the CPI for all urban consumers, or CPI/W. I think that's the acronym for it. And what that measures is inflation accounting for the substitution for goods as inflation rises. Now, we can argue whether that's correct or not. Some argue that that understates inflation because that's not fair. They say you can't do substitutions. It sort of misses the point. But anyway, the CPU-W, and that is actually the inflation rate used to adjust tax brackets over time. And it's also used for adjusting your Social Security benefit over time. So that's essentially what inflation is. And that's the measure that we're going to use. We're just going to use CPI because that's where you get the most data. Now, next week, what we're going to do is we're going to talk about specifically where does this measure of inflation impact you for the good from a Social Security standpoint, but also to the bad, so we can have an idea of what does this mean to me? What does this mean to you? With that, let's go have a chat and answer your questions with Andy Panko. This episode is sponsored by LTCI Partners. The cost of extended healthcare is a risk to confidently rocking retirement, and they provide insurance solutions to help manage this risk. The fact is that healthcare insurance, even through the ACA or Medicare, were never designed to cover the type of expenses you would have in the event of a long-term care event. Doing some proper planning in managing this risk can help you make your retirement plan more resilient and give you a couple of things that are pretty important, I think. One, that can help you have more choices in the type and setting of care you receive, some more control, and help your loved ones maintain their emotional and financial well-being. You can learn more at ltcipartners.com/RAM, where you can learn the basics about how to manage this long-term care risk. One quick note here, Andy just came out with a new podcast, which you can find anywhere, Taxes in Retirement with Andy Panko. And I can pretty much tell you it's going to be great. So check it out. Now let's go chat with Andy and answer some of your questions. I'm laughing because I have Andy Panko on to answer questions, and that always makes me laugh because Andy is a funny guy. How you doing, Andy?
I'm great. Thank you for having me, Roger. How are you doing?
Good. Before we start, even though it's early February, we haven't chatted on the show yet. So I want to know what your word is for the year.
My word is appreciation. Appreciation for a lot of things, for my professional life going well, personal life going well. Got over COVID recently, appreciative for making it through unscathed and hopefully or near the other side of this thing. So a lot of things to appreciate this year.
That's a good word. That's a good word. They say appreciation or gratefulness is will increase your happiness by. They actually put a percentage to it, but I don't buy the percentage part. I like that word, but I'm really interested in what your response was when we first asked you what your word for the year was.
I see where you're going. So partly as a joke, I said my word for this year would be Dr. Pepper. And I don't know why. I just really like Dr. Pepper and always have. And I did a business trip down to Texas a handful of years ago in Waco, coincidentally. And as I was driving around downtown Waco, happened to see there's a Dr. Pepper museum, which blew my mind. I wasn't able to go because it had already closed for the day. And I was leaving town that day. But next year when I went back, I made a point to go to the Dr. Pepper Museum in Waco and found that they have like a Dr. Pepper restaurant/bar there where there's real sugar Dr. Pepper, not high fructose corn syrup. And man, it changed my life. And it was in glass bottles too. So that was an absolute dream for me to be in the Dr. Pepper Mecca with glass bottled real sugar Dr. Pepper. Anyway, so when Nicole asked me, I just thought, Dr. Pepper, let's go with it.
I'm trying to remember the name. Dublin, Texas is like Dr. Pepper. And I've been there and had the sugarcane version of Dr. Pepper. Very sweet, just like you are, Andy. Thanks for sharing that. Now, if you have a question for us, you can go to rogerwhitney.com/ask Roger, and you can type in your question. And if you want super brownie points, you can leave an audio question. We love audio questions. So you ready to answer some questions?
I am. Looking forward to it.
Okay. So our first question comes from John. And John is struggling here with a very tactical question. This is in the optimization pillar of planning. He says, hey, Roger, I've been listening to your podcast for several years now and find it invaluable, which is awesome. I have a question that I've been wanting to ask someone, and it seems like this month with your focus on taxes, and Andy as well, so obviously this is an older question, back when we did our series, I think it was in September or so, would be perfect. So I'm sorry I'm getting to this late, John. The short question is, if someone is in their mid-50s, retired, and has low ordinary income, would it be better to do a Roth conversion or to take advantage of the 0% capital gains tax rate and sell some positions in the brokerage account? And John gives some context here, a couple paragraphs of his financials, which we won't go into. But I guess the central question is, Andy, especially if you're in a low income where you can have the 0% capital gains tax rate, if you have a lot of after-tax unrealized capital gains, and then you have IRA assets, how do you determine whether to do conversions or to realize some of those capital gains and perhaps reset those cost bases?
This is a great question, John. Thank you. And it's common, maybe not this exact question, but things like it, where there isn't necessarily an obvious answer. And this, like Roger mentioned, is one of those optimization things where you can easily get lost in the weeds and all of the various inputs you're trying to consider and just get, analysis paralysis or whatever you choose to call it. I have a few thoughts. Based on some of the other info you gave, the IRA size, for example, isn't trivial. So you're going to have to take that money at some point, if not now in your 50s, under current legislation, when you turn 72, you'll have to start taking it out. You will have to start paying income tax on it at the time. So why not perhaps get ahead of that now over the next better part of 20 years, especially the next few years, while federal income tax rates are objectively lower than we know they're going to be in 2026, if not sooner, as part of the Tax Cuts and Jobs Act expiring. So you're going to have to take it anyway at some point. Why not take it now while you have a little more control, while you know tax rates are low? Now, yes, to your point, based on the figures you gave, you do have a fairly sizable amount of unrealized capital gains in your brokerage account, which, yes, you can sell some this year if you choose to and pay 0% federal tax on it. State tax may be a different story, but federal at least, 0% on some of it, as you laid out. I would think, and we don't know for sure because we can't predict the future, but my thought is probably ultimately be better off from getting ahead of the IRA money. It doesn't necessarily have to be a conversion per se. It could be just a simple distribution, whether you take it to pay some living expenses, or if you don't need it, turn around, reinvest it either through a conversion or into a taxable brokerage account. Because again, you're going to have to realize that at some point, your brokerage account, maybe you'll never actually need any of that money. So you're never going to need to sell any of it, in which case you're not going to have to realize those gains necessarily during your life. Maybe you take them to the grave, so to say, and leave them to whomever your beneficiaries are going to be, at which point all those gains magically go away due to what's called step up in basis. So that's my thoughts. Again, we don't know what ultimately will be the right decision. Hindsight's always 20/20. But from where I sit today with what I know, I would lean towards trimming down your IRA as opposed to taking advantage of the 0% long-term capital gains.
Yeah, and I think that's good perspective, Andy. And it's not a decision, right? Once you make this decision, say to do this, it's really a year-by-year decision based on what's going on in your life and policy and priorities. So it's not like you're going to set a course and never be able to pivot from it, right?
That's exactly it. This tax planning stuff really does need to be a year by year. I use the word tactical, which sounds a little nerdy and overly formal, but have a basic idea. You have an IRA of X amount of dollars, have a loose idea what you want to do. Do you want to convert it? Do you want to distribute it? Do you want to let it sit and bake and then worry about it later when required distribution start? But each year is when you actually put pencil to paper based on, like you said, Roger, what's your other sources of income for the year? How has your life changed in good, bad, or indifferent? What's tax legislation doing? Is it more or less favorable? All those things will dictate what you actually do with dollars and cents in tax planning, any given year.
And with your after-tax assets, you have at least some options, right? I think one easy one, if you're retired and you're needing income, whether it's is to turn off the reinvestment of capital gains and interest, because you're going to pay tax on those amounts. And generally, we just let those turn and buy more and more and more, which is a good strategy for accumulation. But if you're semi-retired and you want some excess income, you can stop at buying more shares and then offset how much you might need from things. And I guess that from a practical manner, you could never sell those positions and use things like secure line of credits and access money in different ways. That's a little bit more, I was going to say sophisticated. It's not really that sophisticated. It's just a little bit more introducing another element to it. There is the question here, Andy, of policy risk. And that's, I think, where a lot of people are thinking about this, right? One is the tax rates, which you mentioned. The Build Back Better bill, which is fun to say 3 times fast, is talking about curtailing for some people Roth conversions. And as soon as something gets talked about in some way, the worry is, wow, they're going to iterate more on that. I know I had a client about a year ago, right after the election, didn't need the money, but wanted to realize a lot of capital gains in worry that the capital gains was going to go to the tax rates. And it ended up not happening. And so I think the way that one fell out with that particular case was, it was an optimization question. It wasn't going to hurt one way or the other. So we did a little bit. And my general approach on that is I give my opinion. I'm like, in this case, no, I don't think that makes any sense. I don't think we should do it, but I am hesitant as long as it's not, if you're marching above the death line, so to speak, if they're passionate about, okay, let's do a little bit. That way you can feel good about it. But I know there's worry about capital gains going up too.
Exactly. There's always going to be legislative risk, tax policy risk to worry about. Especially last year, there was a lot of things batted around, talked about, actually put forth in draft legislation, aka bills, like the Build Back Better bill. I'm a sucker for alliteration. Ultimately, I don't want to say it died on the vine, but the House passed it and the Senate denied it, sort of at the 11th hour. Senator Manchin of West Virginia put the kibosh on it. So who knows where it stands now? Will it get resurrected? If it does, is it going to be watered down or otherwise changed? Will it see the light of day at all? Or, not to make things political, but this year we have midterm elections happening. Depending how those go, if nothing, if no law is signed into place before then, if political powers change with these upcoming elections, you can basically throw all this stuff out the window that we've been talking about the last year with tax legislation, policy changes.
I like your approach of, I think, the Roth conversions, because that's the thing usually people get behind the curve on with required minimum distributions.
Yeah.
So I like that approach. Andy, I forgot to even mention you, other than just talking about Dr. Pepper. So you run Tenon Financial, tenonfinancial.com. And remind me your Facebook group. You have a taxes Facebook group.
Taxes in Retirement. It's a place to discuss and get questions answered and see me do a weekly live video, often with Q&A about various retirement planning topics, generally with a sort of tax-focused tax angle to them.
Yeah, very worth checking out. Very worth checking out.
Thank you.
So our next question comes from, this is another word for iteration, Santiago. Love that word. Wants to talk about Roth conversions. He says, found the podcast a few months ago. Love it. Good. I'm glad, Santiago. And he has a question about Roth conversion. Am I understanding this correctly? He wants to know. If I had $20,000 in an IRA, could I convert this to a Roth and pay the taxes on it? But if I start with an opening a traditional IRA and contribute $7,000, is that all that I can do in that year? And I think he's conflating contributing to IRAs, Roth IRAs in this case, and doing Roth conversion. So you want to talk about the difference and the limits on those two things?
Sure, definitely. Great question, Santiago. And yes, there's sort of a mixing of two different concepts here. One is a contribution. A contribution is when you directly put money into a traditional IRA or a Roth IRA. And you referenced $7,000. So that is, if you are 50 or older this year, you can contribute up to $7,000 into a combination of Roth IRAs or individuals. You can't do 7,000 in each. You can put 7,000 in one, 7,000 in the other, or you can do like 3,500 in both, for example. So that's a contribution, newly putting money into one of those two accounts. On the other hand, a conversion is when you have money already in a tax-deferred account, such as a traditional IRA, and you move /transfer/convert some or all of that money from that traditional IRA to the Roth. There's no limit on how much you can convert in any given year. There's no limit around your age, your income, or lack thereof. Anyone can do a conversion if they have money already in a tax-deferred account. So you can do as much as you want. So you can convert the $20,000 in your case that you already have in a traditional IRA. Separately, additionally, you can potentially contribute another $7,000 into a traditional IRA you mentioned here, and then convert that over to the Roth as well. So all in, you'd have a total of $27,000 of conversions done for the year.
Yeah, and I think some of the conflating might have come about from the concept of a backdoor Roth contribution, which nobody even likes that term. So you're exactly correct. You can contribute to a Roth IRA, but then they have limits on your income where if you make over a certain amount, I'm trying to see if I have that number in front of me. You probably know that off the top of your head, don't you, Andy?
For 2022, for a Roth IRA contribution, if you're single and your gross income is below $129,000, you can make up to the full contribution amount. If your income's over $144,000, you can't contribute at all, at least not directly to a Roth. If your income's somewhere in between, there's this sort of linear phasing portion. If you're married filing joint, the limits are below $204,000. You can make the full contribution. Above $214,000, you can't contribute at all. And in between, there's this phase out process.
Yeah, so that's a whole nother discussion. But I think you can definitely do the Roth conversions for as much as you want.
That's right. Just be aware you'll pay tax, which you already pointed out, Santiago. So some people not often, but I've seen people get a little heavy-handed with conversions and underestimate the tax they'll have to pay when you consider the tax on the conversion on top of tax from their other income. So just be aware of what you're doing and the tax implications of it.
I'm actually worried a little bit about that this year when I do my taxes for 21, because I switched my contributions to my 401k to Roth, right? And for myself and for my wife. So that's roughly $50,000+ that is just going into my Roth in a 401k version. And I pay estimated taxes. And I've been trying to put it in there, but I'm like, well, yeah, I got this $50,000+ in income that I'm not even really thinking about that I'm paying taxes on. So I'll have to see how that flushes out.
Yeah, me too. I mean, obviously doing tax projections and knowing this stuff well is kind of what I do. So I do it for myself, but I've gotten this wrong. I've underestimated myself, and I have had to pay some underpayment penalties, which sound like a dirty, nasty thing, but it's not. Ultimately, depending how much you underpay, you're looking at tens of dollars, maybe a couple $100, unless you underpay by, tens of thousands of dollars of taxes. Don't let these underpayment penalties scare you, and don't feel like you have to nail down to the penny your exact tax projections for the year.
Yeah, and this is a whole nother discussion, but if you're making estimated tax payments, which is something that a lot of retirees do, right? Because they're taking money out of IRAs and maybe they're not having taxes withheld, you want to make those estimated tax payments. I tend to err to personally, because I pay estimated tax payments and my income varies, I tend to not do what the CPA tells me to do, which is the safe harbor. Right? Because based on your last year's tax returns, they'll give you coupons and say, if as long as you send this amount every quarter, then you won't incur penalties, even if you were supposed to pay more. That works unless your income really goes up, whether it's because of a Roth conversion or some other thing. I usually I'm a little heavy on my tax payments. I pay like 30% of whatever dollar I bring in, and it always sort of works out.
Good.
All right, our next question is from John on Social Security and early retirement. And this is a little bit confusing. Some people don't even realize that this is the case. So John, good job for even knowing that this is the case. Some thoughts you shared on bringing another Social Security question to mind. So something I'd shared previously. The Social Security benefits calculator seems to allow that retirement age be the same age as when you start benefits. What if I plan to retire at age 60? How do I adjust the calculator for those non-earning years between age 60 and benefits elections at 62, 67, or 70? I need to think this through. And a lot of times I think what happens, Andy and John, is that when you log into your Social Security site, which I suggest that you do, because then you can see your estimated benefit. And then you can also see all of your earnings years that are used in the calculation, which is always fun. See how much you made the first year you had a job. And you can either log into your account or create an account at ssa.gov. It'll show you what the projected Social Security benefit is at age 62, at full retirement age, and age 70. But that is assuming that you work up into those dates from a calculation standpoint. So if you're retiring early, Andy, how do you get a more accurate estimate of what your benefit might be, say, if you're retiring at 57, like John?
Yeah, definitely a common question and occurrence. And just stepping back regarding getting yourself an online account at ssa.gov, if you don't already, everyone should, regardless of age, even if you're decades away from potentially retiring. And the reason why I say that is a fewfold. One, you can go in there and you can see what your historical record of earnings are. It's quite possible, and it does happen, where employers misreport or underreport your earnings to the Social Security Administration, which ultimately means you're going to get shortchanged benefit. So you can log in, see your earnings, and you try to correct them if possible. Also, it just helps for planning purposes, so you know what you're kind of working with. But also, information security or identity theft, avoidance or minimization. By you creating your account for you, you are one step ahead of some nefarious actor, some fraudulent person trying to create an account as you on your behalf to potentially fraudulently file for benefits as you. So do that first and do that ASAP if you haven't already. Back to the question. So yes, when you look at your statement you get from Social Security, it'll tell you your anticipated benefit at 62 is X, at 70 is Y, and at your full retirement age is Z. Like you said, Roger, and John, as you mentioned, if you look at your age 70 amount, for example, it assumes you work up until your age 70. And therefore, it assumes you're potentially paying into the system all of those years up through 70. So all else equal, that could mean a higher benefit than if you stop working earlier because you won't have those additional years of paying in. And that's the origin of John's question here. So there is actually an online benefits calculator on ssa.gov, which I guess, Roger, if there's a way we can share a link at some point. But
yeah, we'll put it in Six Shot Saturday.
Okay, great. It lets you put in your date of birth, the age at which you plan to stop working, not start your benefits, but actually stop working. And it'll let you put in every year's earnings to the dollar. So it can manually grind out the calculation of your benefit. And it'll ask what earnings you made this year and what you expect your earnings to be going forward. So for example, if you're 55 and you decide to stop working this year, you can say, I'll have no more earnings going forward. So when you run this calculator on the site, it will then show you, okay, inclusive of assuming zeros for this year going forward, what would your benefit look like if you started at 62, 67, whatever? That's the best way to do it. Now, for what it's worth, when you use this calculator, if you put in any assumed retirement age younger than 62, it will assume you start your benefit at 62. So when you look at the projected benefit, it'll show you maybe like, wow, that's really low, but that's on the assumption you're starting at 62. So now you kind of have to do some math, which probably beyond the scope of this podcast, but you can back into what would it be at 67, full retirement age, or what would it be at 70 from that age 62 amount. Or another super simple back of the envelope process is if you're already close to 60 or 62, I'm sorry. So let's say you're 60, you plan on stopping work now. You can just look at your online estimate, take the age 62 amount. It's going to be close enough. Those extra 2 years probably aren't going to have much difference in your calculation, even though the estimate assumes you're working up through 62 and you actually stop at 60. For most people, it's not going to move the needle. So that's another sort of back of the envelope way you can get at it with early retirement. That won't work if you stop at 40, but if you stop close to 60, that's kind of a close enough estimate.
And I haven't used the calculator in a while, but I think another way you could do it is just say you're going to retire at full retirement age, but then put zeros If you're retiring at 55, just put zeros from 56 through 65. Then it knows the years of earnings they're going to go into the calculation. I think that will work. I haven't done it in a while.
Yeah, good point. That makes sense. It sounds like that should work. So that's a better way than what I described. Yeah.
When I have done this with someone retiring in the late 50s, it generally isn't a material difference. There's some difference in what the full retirement benefit will be, but it hasn't been anything dramatically different that would have changed planning. Now, if you get earlier in life, no doubt it might be. This actually would be an interesting exercise to do with my wife because she, quote unquote, retired at, we'll call it 50. And I just put her back on the payroll because she's doing some work for me now to see what her record shows, because she was a high earner, but then she stopped at age 50 and now she's starting to get, because then you can play, because maybe she needs to earn more money between now and then, even if it's just for 2 years, it might bump off some zeros to help the payment. I'll have to play with that. Sounds like a good rainy day Saturday morning exercise.
It is. And the other thing people should keep in mind with Social Security estimates is when you look at your statement, it does not have any sort of baked in cost of living or inflation assumptions. So if you're 60, you plan on stopping work at 62, and you look at your statement, or 65 or 67 or whatever, you look at your statement, it projects a benefit of X dollars. In actuality, your benefit will be higher because there will be some sort of non-zero inflation each year going forward, or most years going forward. So the actual benefit you'll end up getting at the time will almost certainly be larger than what your projection thinks it will be as of today. So keep that in mind.
Wow, you just answered a question I think I have in queue for a few weeks from now. So,
oh, wow, I'm an oracle.
Yeah, I don't have to do any research on that. Thank you, Mr. Panko. Now, our last question is related to the theme of this month, which is inflation and retirement, which is what we've been talking about all month. Inflation is hot right now as a topic anyway, and literally, I guess. And Adam wants my thoughts on early retirement. Now, Adam shares a lot of perspective, and for the sake of time, I want to just consolidate it. Essentially, the question is, Adam is quote unquote pre-tired, which is he's working part-time. He's not working a full-time career type of job. And he and his wife are in their 40s, and both of them plan to take full retirement in their 50s. What should they be worried about? And is inflation a big factor in this because they're so young? The fact that they're so young, how does that elevate the inflation risk? And he gives some backstory. They have $1 million plus in 401ks. They have 9 rental properties and some other assets. So he gives us some framework. So is it demonstrably different than a normal retiree given the expanded time frame? That's a big question to end on, isn't it?
And it's an important question, and the question I'm sure a lot of people have, especially as the financially independent retire early concept and movement catches on and more people aspire towards it. And especially inflation clearly large in the last year and a very hot topic. I mean, me alone, my gym membership doubled from $10 to $20 a month. Granted, 10 was probably less than it should have been.
That's just because they had to buy bigger weights because they didn't have weights big enough for you to use.
That's it, because I'm an animal, yeah. And my tax return software went up 50% per return. Now, granted, it only went from $20 to $30, but in percentage terms, that's a big jump. So anyway, one thing I noticed you said here, Adam, was 9 rental properties. Now, I don't know how much income those actually throw off for you, but my guess is those are probably a pretty good inflation hedge to start with, because the value of the properties themselves should typically, historically at least, do well with inflation. Now, unless they're all isolated in some particular spot that ends up being like a Chernobyl or something, then they all go to zero. But let's assume that's not the case. And the income itself should hopefully be a pretty good, or should be able to keep pace with inflation. All else equal, you should be able to raise your rent by the amount of inflation, give or take, every year. So if that's a substantial part of your income plan in your retirement, then you're hopefully okay. Outside of that, yes, inflation is potentially this big unknown sort of lurking force that, unfortunately, I do think the longer your anticipated retirement period, the more potential damage inflation can do, just simply because there's that much more time for things to change or potentially not go your way. Do you agree with that, Roger?
I do. And I think you're right. The real estate properties are a natural inflation hedge, even if we ignore the values, because those can be very volatile. Yeah. I mean, even if we ignore the values, the cost of renting a home, the rents that you can charge, is a wonderful inflation hedge. I think there are probably other risks that are just as large whether it's sequence of return risk. He was talking about working in the wine industry. If you're going to start a business, there's a whole different risk in starting a business. And I think it's just something you're going to have to, we talk about being agile. You're going to want to have levers that you can pull as you continually iterate on this, because it is a risk, just like sequence of return risk is. So I don't know if it's really that much more elevated other than there's a longer time frame, because if you have a portfolio over time, equities are a decent inflation hedge, because ultimately a company is going to pass on the increase of cost to the consumer. Now, there's always a lag, and sometimes that lag can be long. So if you have a big equity portfolio, you may have an impact as inflation and interest rates rise, so your portfolio may go down. But over time, all these things right themselves as corporations adjust, and they pass on the cost to Andy and his gym membership, or to me and my water bottles or whatever. So you'll have that as an inflation hedge. You'll have your rental properties as an inflation hedge. I think the pre-retirement part of it, and this is where I think with early retirement, I like the financially independent, the retire early part. I'm not as big of believer in. I think the more that you can do work you love, get paid for it, and have time freedom, that's probably one of the biggest things you can do to help make yourself more resilient against, whether it's life risk or inflation.
Yeah, I'd agree with that. Having some sort of income, whether it's gainful employment for someone else, or in your case, potentially operating a winery for income, that all helps, especially if you're young, if you're 40 something. I haven't quite wrapped my head around the retire early thing. Not to say it can't work, but if you're 45 and your plan is to tap out of the workforce altogether and live off the $3 million you saved and live frugally, you might live 50, 60 years. Is that enough? We don't know, to be honest. That makes me a little uneasy. Not to say it can't be done, and hopefully all these people turn out fine, but who knows what healthcare is going to do in 20, 30, 40 years, inflation over 50 years. So I don't know. Not to sound like a nervous Nelly, or I'm saying it can't work. It's just I struggle to, I consciously don't work with folks who are 40 retiring, because I say, sorry, I don't know what I don't know about that. And it's not quite my bag. I'm more traditional retirees who have a 30-ish year horizon is folks I work with. But
in my thought on the retire early part, Andy, and again, I don't work with people in their 40s, and that's not my focus, is probably the two biggest risks equal to inflation that aren't really talked about as much is life risk, just huge expenses from, I have a friend who has his wife in mid 50s has early onset Alzheimer's, and it's aggressive. That changes the spending dynamic dramatically. Or obviously big risks, house burning down, all sorts of things, life risk, life really smacking you in the face is just as volatile and unknowable as inflation. And I think that's a huge risk if you give up one of your superpowers early. And I think the other is execution risk. Because if you're in your 40s and you're early, I'm thinking of starting a winery, I'm thinking of doing these things, I mismanage the properties or something happens, you have a lot longer period of time when things are a lot more fluid, where you better execute reasonably well consistently, or you paint yourself in a bad situation. And I think those are two risks that we don't really talk about when it comes to the early retirement end of it. But I think inflation is definitely something you need to, it sounds like you have things that are already helping you there. And I think it's all about just executing and iterating as it unfolds, because it's going to be just as big as sequence of return risk, depending on where you're going to get your spending from. That's a big question.
Right. It is. It's a heavy one. It's an important one. And I don't know that anyone has a bulletproof answer or solution against inflation, particularly runaway inflation. Absolute extreme worst case scenario. If we have 5 to 10% inflation every year for the next 30 years, we're all in a lot of trouble. And I don't know that there's no way to sugarcoat that. Now, I like to think that can't happen or won't happen. Sure, we're going to continue, I think, to have some peaked inflation for another year, 2 years, perhaps. Who knows? Economics is much more of a art than a science. But I believe it will come under control. It will normalize back to the historical average of 2.5-ish% or thereabouts. If it doesn't, it could be problematic, especially for someone retiring early, stopping the workforce early with 50 or 60 years of time horizon. There's that much more time for bad outcomes to materialize and amplify and compound.
That's a big difference than if you're 60 and hey, I can turn on Social Security and that has some inflation adjustments. So that's all automatically going to help me. and you're definitely too young, and I was way too young. I was not as young, but didn't really experience, but we had runaway inflation in the late 70s, 80s, where we had 10+%. We had huge increases in prices, and you saw everything adjusted, and a lot of it will depend on what season we go into. Just like with sequence of return, we don't know what the next season of return is going to be, just like we don't know what the next season of inflation is going to be. Is it going to be an 80s event? A good book that I'm reading, I like his books, but I'm not a fan of how he writes them. I like his thinking, and that's Sim Taleb. You familiar with him? He wrote Fooled by Randomness.
He's the Black Swan guy too?
Black Swan guy is anti-fragile, things that gain from disorder. And it talks about this, about fragile is breakable, right? And what's the antonym of fragile? You would think robust, right? His argument, actually, it's anti-fragile. There isn't even a word for it. It's anti-fragile, things that gain from diversity or stressors. But it has some comments on how to think through things that we really can't figure out. Interesting book.
Interesting.
Yeah.
Yeah. Sounds like it.
All right, let's go set a smart sprint.
On your marks, get set.
Now we're off to take a little baby step you can take in the next 7 days, not just to rock retirement, but rock life. Optimization. A lot of people focus on optimizing every single thing in their life, especially when it comes to money, because we feel like it's wasteful to have cash sitting there earning 0%. So in the next 7 days, I want you to think about optimization as it relates to having slack in the system. I recently was thinking about this with myself because I just got back literally this morning. I had to get up about 4 a.m. to catch my flight back to Texas. And I've been talking how I don't want to travel as much and I want margin in my life. Well, when I was sitting in the hotel last night, actually, I was saying, wow, okay, end of January. I'm trying to keep my calendar open. And I traveled 13 days in the month of January. And outside of those 13 days, when I wasn't traveling, I had very full schedule of client meetings, recording shows like this, and creating stuff with the Rock Retirement Club. It's all awesome. It's very optimized from a scheduling standpoint, and I love doing it. But when you add in the travel, it may be optimized, but there's no room for error. Optimization can be very brittle. You have a hiccup, pinched nerve in your neck, a missed airline flight, COVID or the flu, everything breaks down really quickly because it's so optimized. And in your retirement journey, when you're trying to optimize your dollars and your tax strategy and everything else, it's very easy to make it so complicated that you are fragile when inflation spikes or markets go down or something changes. There's a big return on having slack in the system. I'm finishing up Anti-Fragile by Nassim Taleb. It's a good book, not an easy read, but the concepts are really important. And so right now, and this is where we talk about the income floor, having cash reserves as a contingency fund, and then building out your runway of money to pay for your life, that is essentially giving you slack in the system. So when inflation spikes or something happens in your life, or the markets go down, or all three happen together, you can absorb and still continue on and not break. So I want you to think about that over the next week or so and ask yourself, do I have enough slack in my system? I'm excited for this month in February. It's a big topic. If you have questions for the show, go to rogerwhitty.com/ask Roger. Check out rockretirementclub.com. We're open for enrollment up until Sunday, February 6th, and then we'll close it and have a waiting list. And this way we can bring everybody in together. I can tell you these cohorts I'm really excited about because we can all work together to help everybody get their plan of record so they can have a framework to have more confidence to rock retirement. So check that out at rockretirementclub.com and have a great week. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.